Hi, everybody. It's Joe Fenech, Chief Investment Officer of GenOpp Capital Management. Welcome to podcast episode number 6. Our last episode came right after Fifth Third announced it planned to acquire Comerica, and we walked through what we thought that meant for the M&A landscape. Since then, we've been through third quarter earnings season. Layered onto that, we had the government shutdown, the Fed meeting, Powell's commentary, the Jamie Dimon cockroach comment after a few wayward credits surfaced, renewed activist noise in the banking space, and pretty significant volatility in the stocks. And that's just the past few weeks. So with that, let's get into it after a quick disclosure. Joe Fenech and Kevin Swanson are employees of GenOpp Capital Management, an investment advisor that maintains exempt reporting status in the state of Indiana. This podcast represents the views, beliefs, and opinions of GenOpp members and does not assert to be complete. The information presented in this podcast is provided to you as the dates indicated, and opinions presented may change. You should not rely on this podcast as a basis upon which to make an investment decision. This podcast is not intended to provide and should not be relied upon for tax, legal, accounting, or investment advice. GenOpp's clients or its members may hold or recommend to GenOpp's private fund clients purchase or sale of securities of companies discussed in episodes of this podcast. Okay, so let's start with bank stock performance over these last couple months. The stocks have traded poorly. They had a really strong run off the Liberation Day lows in April. Things peaked in early September, and then the stocks fell about 12% in a month. They bounced a bit since, but we're still down just under about 10% from September highs. The S&P's up over the same period, so you've got about an 11 to 12 point spread, which is meaningful between how the S&P's performed and how the regional bank stock index has performed. Normally, we don't draw sweeping conclusions from 2 months of performance, and to be fair, there are definitely things you can point to that give credence to a bearish argument here and a justified sell-off. You had the Tricolor and First Brands bankruptcies. So you had some fraud type situations disclosed at Western Alliance and Zions, two big regional banks. You had Jamie Dimon, of course, with the cockroach comment. The peak of that concern came when these disclosures sort of clustered together. The worst of it coalesced in that 6% plus down day in one day in the regional bank index in mid-October. So that's really the bear case in a nutshell. But when you take a step back, we've been asking, does that explanation really hold up? We've been through dozens of earnings reports at this point, talked to a lot of senior executives around the country, and the evidence just doesn't support the idea that we're heading into some broad credit cycle. I think back to 2007 when I was on the sell side as an analyst, heading into '08, of the 20 plus stocks I covered at the time, I didn't have a single buy rating. And that wasn't because I predicted Lehman a year ahead of time and the financial crisis in September of '08, but it was because when I traveled around meeting with the small banks that I covered in late '07, when you juxtaposed where the stocks were trading against the stories that people had to tell in late '07, nothing seemed compelling. It was very difficult to come up with price targets that were higher than where the stocks were trading at the time. The bottom-up work of visiting and talking to all these little banks and doing the work informed the top-down call. Right now, it feels like the reverse. We've got what we call our regional gurus, multiple bank executives in every corner of the country who we trust. When things get choppy, we check in with them and we ask, does what you're seeing on the ground match what the market narrative seems to be? But we also talk to the subpar performers because problems don't start with the A students. And when you take their commentary, all the people we're talking about, you measure that against the valuations in the market today and the results we're seeing, we come to almost the opposite conclusion we came to in '07. It's kind of hard to find stuff that we don't like. So again, it's the bottom-up analysis informing the top-down call here. So there's that. And then another thing caught our eye recently, the bank sector has had the strongest positive revision to fourth quarter earnings expectations of any sector in the market. Since October 1st, analysts have taken up their fourth quarter EPS projections for banks on average by about 3%. No other sector saw more than a 2% upward revision, and several sectors had negative earnings revisions. So sometimes, but not always, but sometimes you have to look through the market reaction and almost ignore it. Take the emotional reaction to the stock performance out of it and ask, what are the actual facts? And when you do that, the hard data here just doesn't line up with the idea that the sector's on the cusp of disaster. Certainly not to the extent that the stock performance is implied. So that's the quantitative. The qualitative indicators also don't seem to line up with that disaster scenario either. So we've now seen 3 large regional bank merger announcements. I want to focus for a second on the Fifth Third Comerica deal. We've talked about the high regard we have for Fifth Third's CEO, Tim Spence. This deal is sort of his coming out party on the big stage, with the big stage being defined for us as, front page of the Wall Street Journal type stuff. Tim Spence is also by far the youngest of the big regional bank CEOs. Doing a deal of this size at the very front end of a major credit cycle is a potential career killer. So look, no one's infallible, but in our view, one of the brightest minds in the industry is not stepping into the largest bank transaction we've seen in a while with all eyes on him to buy one of the largest commercial middle market lenders in the country if he has any real concern about the macro backdrop. Steve Steinauer, CEO of Huntington, similar theme there. Huntington now has announced 2 significantly sized transactions in the last few months, including one in the last few weeks. You put all that together and you consider it against the recent stock price action, and the narrative that we think's developed around that just doesn't seem to fit. Now, this isn't to say that we don't have concerns or things we're watching pretty closely. We're very wary about some of the things we've seen in private equity and private credit, and the regulated banking system certainly isn't immune to what's taking place there. We're going to do a podcast episode on that at some point soon. So the point isn't that there are no warning signs. It's just that the totality of what we've seen and heard doesn't support the idea that we're on the verge of some credit conflagration, right? So what else could be going on here? So, we've talked about this before we even launched the fund for several years on the sell side, and that is that the '08 financial crisis really changed everything. The response to that crisis pushed monetary and fiscal policy into totally unprecedented territory. You see the fiscal side and the federal debt. On the monetary policy side, the big tell is the size of the Fed's balance sheet. Before '08, it was under $1 trillion. A few years later, it was $4 trillion in response to the '08 crisis. Then COVID hits and it goes to $9 trillion. And before COVID, every time the Fed tried to shrink the balance sheet, something somewhere in the system broke and the Fed had to reverse course. And the best example of this was in the 2018-2019 timeframe. The Fed started quantitative tightening, QT, and bank stocks fell pretty sharply in the back half of 18. That all sort of culminated in the repo market blow up in September of 2019. It was pretty serious, but it was short-lived, right? Because the Fed moved immediately to restart a light form of QE. And markets stabilized and bank stocks drifted higher from there into early 2020 with COVID. At the core of what happened in that repo crisis was some key money market rates spiked. And the one I would point to is SOFR, the secured overnight financing rate. SOFR went from 3% to 9% in 2 days back then. What that indicates is sort of like a proxy for the plumbing of the financial system. And so the plumbing of the financial system basically clogged up somewhere at that point. Now, none of this stuff gets the attention it deserves because, a few reasons. It's complicated. It's behind the scenes. There's not a lot of transparency. And let's be honest, it's boring. People by default tend to talk about the Fed funds rate because it's a simple concept, right? The Fed raises the rate, they lower the rate, great. We would argue that QE and QT and the associated liquidity dynamics that happen behind the scenes related to that matter a heck of a lot more than the 25 basis point move at a Fed meeting. And banks are right at the tip of the spear on all this. They're risk assets. They depend enormously on the plumbing of the system functioning properly. So a lot of the seemingly mysterious moves in bank stocks since '08, both up and down, we think can be traced to these liquidity dynamics. So what happened this September? SOFR went a little haywire again, not to 2019 levels, but enough to raise eyebrows. And honestly, you could argue it might have been better for the stocks, for bank stocks, if it had spiked more dramatically, because that probably would have forced the Fed's hand right away to do something. Instead, they've just sort of been watching this and sending some telling signals. So here's what you have. Fundamentally, banks have been cruising along the last 2 months. The Fed had just pivoted toward a lower rate stance in August. Bank stocks were trading at all-time low valuations relative to the S&P. M&A is starting to pick up again. Deregulation's happening. Earnings estimates are being revised higher. That was where we were late summer and into the early fall. And then out of nowhere, the stocks start to slide. And remember, a good portion of this slide happened before the credit headlines really surfaced that worried people in October. Another worrying sign for us is that bank reserves held at the Fed, which is basically the liquidity cushion, right, for liquidity system wide, they fell sharply over the summer and into September. QT has had its effect on that. And, now bank reserves at the Fed are down to basically the lowest level since the pandemic. Then the government shuts down on October 1st, and that has implications for the Treasury's actions in all this. I won't hit all those details, but bottom line, that also impacts liquidity. So now you have all these things hitting at once, a perfect storm of we'll call it plumbing related liquidity pressures behind the scenes. Then earnings season rolls around and earnings are very solid, but the credit blips show up. And to us, it's sort of like, throwing a match on a pile of wood soaked in kerosene, the liquidity backdrop being the kerosene, and the match is the credit issues, right? Then Powell speaks after the October Fed meeting. And going into that meeting, the consensus among what we'll call the liquidity watchers, there's a whole group of people at different investment banks that actually write research on this stuff. But the consensus there was that Powell would basically end QT immediately because of the pressures that were happening in the plumbing that we talked about earlier, right? Instead, Powell said QT would continue till December 1st. And so that added more pressure. QT is continuing to go on amidst all these pressures. And when liquidity tightens unexpectedly, that's when you get these weird, exaggerated moves in bank stocks, which don't tend to align with the fundamentals of the businesses. So the good news sitting here now on November 14th, when we're recording this, is that some of these pressures have started to ease, but not by nearly enough yet, in our opinion. So, on the one hand, the shutdown's over, so some relief there. On the other hand, SOFR, bank reserve levels, and a few other indicators that we watch are still signaling liquidity stress. And interestingly, John Williams, the president of the New York Fed, for all people that are interested in this, I'd encourage you to go back and read his speech earlier this week. He gave basically a primer on the rationale for ending QT. And he even went so far as to suggest the Fed may soon start growing its balance sheet again, which would be a tailwind, we think, for risk assets. So why does this all matter? Because for years we've been saying that you can't analyze this sector in a vacuum. You can't look only inside banks to explain how the stocks trade and bank fundamentals. You have to consider the macro foundation and these policy distortions because those forces have had an outsized influence on these stocks since '08. So to us, the underperformance since '08 is really a two-part story. First, the macro foundation's been unstable, right? And this is a sector that needs some semblance of stability, whether it's interest rates, whatever else. And second, the distortions in monetary and fiscal policy since '08, and especially since 2020, have had huge, but we think underappreciated effects on bank stock behavior. And when the key drivers of stock performance are things that the companies can't control, sort of these, we'll call it opaque outside forces, the market just won't give the sector a big multiple. So similar to the mortgage business, you could run the best mortgage shop on earth, but if rates go the wrong way, the business shrinks, right? So the market says, okay, we're not giving that a premium. So our thesis is that we're at an inflection point right now, one that's favorable for the banks. The fundamentals are excellent. Margins are expanding for the first time in almost 20 years. Regulations loosening, M&A is picking up, bank stocks are extremely cheap, while the overall market is very expensive by historical measures. So everything tied to the fundamentals of this sector is pointing in the right direction. That's the upside. The risk is that these outside distortions don't fade as cleanly or as quickly as we'd like. So the setup is moving in our direction, but we think it's important to understand the risks and what to watch for, and to also understand that sometimes the risks and the drivers of stock performance aren't what the consensus narrative thinks they are. So our strategy as fund manager here is really pretty simple. First, try to correctly diagnose the problem, which we think we have. So these liquidity challenges are very real, but at the same time, the Fed has the tools to fix this very quickly. So if you misdiagnose this situation as a major credit problem as a fund manager, and then the Fed steps in and solves for the real issue, then you're too defensively positioned. So you want to be cognizant of that. At the same time, though, it's very, very difficult to try to market time these situations when the situation is opaque and there's a lack of transparency, right? So our approach is to be appropriately cautious. We prepare for any potential outcomes, including that we're wrong and the credit problem is more significant than we think. But ultimately, we're staying focused on the fundamentals, which remain excellent and still improving for the sector, and the attractive valuation backdrop overlaying all this. And you weather the storm in the interim through all these bumps and bruises along the way. We see that as the surest path to long-term success, provided that our fundamental outlook doesn't change. And as of now, it has not. So that's basically our commentary on sort of bank stock performance, kind of our diagnosis of what's been going on and what we're doing about it. So let's move on. That last topic's important, but not the most exciting discussion topic. So let's shift gears to something that is both important and exciting. M&A and shareholder activism. M&A, we think, is going to play an increasingly important role in this sector over the next several years. We've been saying that, and it's starting to happen. We talked last time about our thesis on regional bank M&A, how we divide the 25 regional banks over 50 billion in assets into two buckets. We call them the hunters and the hunted. And we've said that in this M&A cycle, the vast majority of those 25 banks are going to fall squarely into one of those two categories. Very few, we think, will just stand pat and do nothing. And since our last podcast, which was only a few weeks ago, we saw two more banks in that group get sorted definitively into those categories. Huntington played the role of hunter with its acquisition of Cadence, which obviously goes into the hunted category. So no real surprise there in terms of where those two banks fit. And again, it fits very consistently into this broader theme on M&A. So we've now seen three large regional combinations, Pinnacle and Synovus, Fifth Third and Comerica, and Huntington and Cadence. Six companies already in that large bank group. And Huntington also announced the deal for Veritex, which was smaller but still significant. These are pretty transformational moves, and we think there's a lot more to come. So within that M&A backdrop, activism has surfaced in the sector in a way that we haven't seen in quite some time. Over the summer, we saw an activist go public with its campaign at Comerica. That same activist has been vocal at other regionals more recently. And here in Indiana, where we're based, we saw a different activist take issue with a bank after it completed a large balance sheet restructuring. CNBC even ran a piece highlighting the overall increased activism in banking. So a few thoughts on that. First, we think there's going to continue to be a lot of noise around activism, but ultimately the bark might turn out to be bigger than the bite. Activism's just tough in this sector, right? The regulations, the ownership rules, the approvals you need, it's not like other industries. Warren Buffett and Charlie Munger have famously said that if it weren't for the Bank Holding Company Act, I believe it was like the early 70s when they were building Berkshire Hathaway, that made it so hard to acquire controlling positions in banks, Berkshire Hathaway would probably have been built with banking at its core and not insurance. So if you're an activist, especially at the big regionals, you might own a mid-single digit, a low single digit percentage of a stock. So on the one hand, that gives you a soapbox, but it doesn't give you the ability to force action. And if your pressure campaign doesn't work, in our view, you're left with sort of this concentrated portfolio of underperforming companies. Not a great place to be, in our opinion, and it's a terrible place to be if you don't get the consolidation wave playing out like you expect. And if you're a good sized fund in this space, let's say $1 billion or more, you can't even focus on small bank activism where an activist campaign might actually be more effective because you can't own enough of the stock for it to matter. So even if a small bank ultimately sells for a 25% premium and you're managing over $1 billion, it doesn't move the needle for your fund's performance, right? You're stuck in this weird business model where you're betting on subpar companies and hoping for improvements you can't force, or you're hoping for an M&A premium you can't guarantee. So it sounds great on paper, but the reality is it's tough, right? So with all that said, it doesn't mean the activists are wrong, in our opinion, right? In fact, some of the broader points they're making, we think, have merit. So you take Comerica. It's been a fundamental underperformer for basically my entire career, and I'm not young. I've been at this for 25 years. The stock was just below $70 per share in the late 90s when I started in this business, and it just sold last month in 2025 for just over $80. So $70 in the late 90s and sold for $80 in late 2025. That's not exactly a victory. And I think those of us that have been in the industry for a while have become almost desensitized to this notion that banks will often decide to sell when the primary decision maker, usually the CEO, occasionally a key board member, just decides they're ready to retire. It's a fact that over the past 25 years, the single best predictor of when a bank will sell is the age of the CEO. Now, investors in most sectors would find that decision tree totally unacceptable, but we've sort of become accustomed to it and accepting of it in banking. So the same rules that sort of make the activist ineffectual in banking enable the management team and the board to sort of run these banks like a fiefdom, right? Because there's really no way to sort of penetrate that and force change. And look, I think if bank stocks are performing well, like they did for the first third of my career and briefly for periods of time since then, people would continue on living with some of these quirks of banking, right? But when the stocks have underperformed and companies are making decisions, not just around selling the company, but we'd extend that to like balance sheet restructurings and things like that. But when the decisions seem disconnected from shareholder value creation, and at the same time, this long-awaited window for large bank M&A is finally open for the first time in almost 20 years, well, that's a recipe for frustrations boiling over. And so that's what we think is happening, and we think we're going to see a lot more of it. And with that, we will sign off for today. As always, please give us your feedback, and we'll be back soon with another episode. Thanks for listening.